Welcome back everyone. So today I'm going to provide a portfolio update as I do most weeks. I'm also going to be talking about how you can invest £100 into the stock market. So what types of considerations you need to make before you start investing. This is just my personal strategy. There's a whole range of alternative ways to invest out there. And then there's Monzo, which has launched their 180 a year premium account. I'm going to be taking a look at that. And then on to Apple, who is actually using their retail stores as a form of distribution. And that in turn is speeding up their product deliveries. So this week I wanted to bring it back to the basics. These days anyone is able to invest into the stock market and it's very easy to do so. And so I want to talk about how I would personally invest £100 or any other amount into the stock market and explain how I would go about searching for what I consider to be useful companies. Now if you are new around here, I primarily invest in dividend-based companies. We can see that on the screen at the moment. And we've seen an overall increase in the portfolio, so the returns right now is at positive 1.54%. Comparing to that of last week, that is a big jump, given that I was in the red by a significant amount. So far this week, we can just see that from the recurring deposits, that cash has been converted into shares. So just a couple of £100 invested into the stock market. Now, setting up Auto Invest is one strategy for having a constant amount of money invested into the stock market each week. But even so, how do we decide whether a company is a good investment or not? So let's just imagine we have £100, we want to spend into the stock market. What options do we have available? And so the first one, and it's probably the most simple, is to invest in an ETF. Now, one of the most common ticker symbols out there is VUSA. I personally invest every month. So on the likes of Trading 212, you can set up a recurring deposit and then you can consistently purchase shares within an ETF. And depending on the type of ETF, you may have global exposure or it could be a little bit more narrow, but it's exposure to a wide variety of companies nonetheless. Now, if you're new to investing, I definitely recommend you having a look at the different types of ETFs out there. It's also arguably safer compared to picking individual stocks. But let's face it, when it comes to picking individual stocks, it's a lot more fun. And so that's what we'll move on to next. Now we can see on Trading 212 that I have different companies invested by different sectors, and that corresponds to different pies. So let's take a look at the real estate sector here, and we can see the different companies that I actually hold. So let's use Realty Income as an example. Now at a basic level, you want to understand what the company does. So if you're able to explain what the given company does to a friend in a sentence or less, that means you have a basic understanding of the company and you're one step closer in investing. The next step is to look at the different metrics. So we have a bunch of information on the likes of Trading 212 that gives us a brief summary and financial reporting in the form of graphs. Now for the most part this is good enough, but I generally like to use Yahoo Finance or an equivalent online site to look a little bit more into the metrics. And so we just head over to Yahoo Finance, and here we can put either the ticker symbol or the company name, and we have a few more metrics at our fingertips. So personally, the first thing that I look at is the revenue. Now most of the time we will actually see these graphs on the right hand side here, and here we have the revenue, which is in green, and that simply means the amount of income that the company generates. Now it's not factoring any of the expenses, and so the next metric that we want to look at is the one right next to, and that is earnings. And so the earnings is really crucial because that determines whether the company is profitable or not. All the expenses are removed, and we can see for each of the given years whether there's an increase in the profitability or if there's a decrease. And with the likes of Realty Income, this is a graph that I want to see. It's perfectly fine for revenue to increase, and generally it does, but we want to make sure that the earnings is increasing year on year. Now if I'm happy with the earnings, the next metric I look at is the PE ratio. Now the PE ratio determines whether a company is over or undervalued. Keep in mind that we need to look at a given sector. So currently we're looking at the real estate sector. There is an associated PE ratio for the given industry, which is different to other sectors. So the easiest way is just to perform yet another Google search. So for instance, the PE ratio for real estate is estimated around 20. So taking 20 as a baseline for the real estate sector, we can decide whether a company is over or undervalued. Now what determines whether something is over or undervalued is in the stock price. So So if the price of the stock decreases, then we'll have a lower PE ratio and vice versa. On the screen here, we can see we have a PE ratio of close to 50. So we're definitely over the median average. And so in this case, the current trade-in price is overvalued. For someone who invests long-term, the PE ratio isn't so much of a factor because you're going to have exposure to different variations in the price level. And so I do hold less weight on the PE ratio. Of course, we always want things at their cheapest, but if you always focus on buying stocks at the cheapest price point, then you're always going to feel bad when you invest constantly, as that can inhibit a long-term investment strategy. So to conclude here with the PE ratio, there isn't actually a magical number that constitutes as a good PE ratio. They are sector specific. For anyone who invests long term, then it does make sense to hold less weight, and even more so if you plan on just purchasing a small amount of stock. So moving on to the next metric. Given that I focus primarily on dividend-based companies, I do hold somewhat of a higher weighting to that of dividend yield. So my focus is to generate constant income every month and ideally grow that income as time progresses. And the dividends make it much easier to receive cash and then reinvest if you wish to. So on the screen we can see we have a forward dividend yield of 4.85%. For me, that's a nice sweet spot. Any values higher, so 6% onwards, it's still investable, but there's an associated risk. And that's simply because companies provide higher dividend yields to attract the investor, but it doesn't necessarily mean that the dividend yield can continuously be paid at that percentage year on year. And so there's just high risk that a dividend yield of say 6 to 12% is not sustainable in the long term. And so it could be argued that a 3% could be better, because if the dividend grows year on year, then eventually you're going to hit around say the 4%. And so you're seeing growth in your portfolio. And so just to make it clear, any percentages above that range, it's still possible to invest in the company, but you'll just have to analyze further to see whether dividend payouts can be paid out year on year and whether or not there's a chance that they can be increased. So next up, the payout ratio. I do hold a significant weight to the payout ratio, and that's because it's a percentage that tells us how much money a company pays out to their shareholders. It really is an underlying metric to tell us whether a company has long-term stability when paying out their dividends. And so usually I do look for companies that pay no higher than 60%. That is, of course, with the exception of REITs, which have to pay out around 90% to their shareholders. Now, on the quick summary here, we don't actually have the payout ratio, but if we look into the statistics, we can scroll down and there we have the payout ratio. So unfortunately, we're at 188% for Realty Income. That's extremely unhealthy. Now, prior to the pandemic, we had much more sensible values. Without a doubt, this is really unhealthy for the company. And if I was new to investing in the likes of Realty Income, I probably would stay away. It's definitely not sustainable for the long term. And in my mind, this figure is a red flag. And so that's generally where I stop looking in terms of the metrics. Those are the key ones that I have in mind. Other people will focus on different metrics or hold different levels of weighting in terms of importance. It's not really a case that if you tick 3 of the metrics and then the last one is a negative, then you shouldn't invest. It's not really like that. You just have to look at all the different metrics. If you're happy with all of them, then that's a great investment opportunity. And then it's somewhat of a guessing game in terms of whether the company can survive long term. Is there any improvements that they can make to some of the metrics that you are unhappy with? And sometimes, given certain economic situations, some of these companies will have a higher probability of doing well in the future. So you really have to think with that long-term strategy in mind. And so the question I have for you this week is, if you have £100 to spend into the stock market, what would you go and spend it on? So let me know in the comment section below, and let's move on to some news. So we have Monzo that has launched their £180 a year premium account. Now, the belief here is that younger customers are the ones that may pay for this additional service. So anyone that signs up to the premium account, you'll receive this metal looking payment card. It's definitely got me hooked already. No, just kidding. So at £180 a year or $15 a month for a minimum of 6 months, you will have access to Monzo Premium. Now, looking at the key features here, we have travel and phone insurance, £600 of fee-free withdrawals abroad each month, and this white steel card with 1.5 interest on deposits up to £2,000. So let's take the first one, travel travel and phone insurance. I can't imagine paying £180 a year just for travel insurance. Now, it does depend on the individual. If you do travel a lot, then I would probably recommend other types of travel insurance out there. A worldwide travel insurance can cost you around £30 the last time that I checked. Now, the 600 fee-free withdrawal, currently on the free version of Monzo, you have £200 of fee-free withdrawals. I believe after that it's 3% on anything above the £200, but it does reset on a rolling 31-day basis. Now, if you are looking for alternatives out there, Starling Bank has the same limit, £200, but it resets every month, and in my view is slightly better. In terms of their MasterCard exchange rates, they're identical as well. So an increase in £400 a month for someone that does spend quite a lot abroad, that could be useful. Some of those fees do add up quite substantially, and so an extra buffer of £400 could be useful there. Now, as for the interest rate of 1.5%, you effectively need £2,000, and from that you'll earn £30 every year. Now, I probably would say 1.5% interest is higher than anywhere else you can get these days, and so you could see it as this is a Monzo premium feature of £150 a year should you decide to invest the £2,000 and keep it there for the year. Now, digging deeper into the actual travel insurance aspect, there is cover cancellations of up to £5,000 and any other flight delays of more than 4 hours. I think the cover cancellation is fine, but you can achieve this with other types of insurance out there. As for flight delays of more than 4 hours, well, there's actually EU-based law out there that says if your plane is delayed for, I believe, 3 hours or more, then you do receive a certain amount of money. And then if you do go with a separate travel insurance policy, then you have all those benefits as well. So for me personally, I would say that if someone is traveling quite often, some of these features are good. Potentially the additional £400 of fee-free withdrawals could be of use. But as an alternative, you could just apply for Starling for free, withdraw £200 there, and then you've got the 200 from Monzo as well. So every month you could withdraw £400 fee-free. So with 4.6 million customers that use Monzo for free, there's definitely a push for the likes of millennials to go out and spend this additional amount of money. I'm really not convinced that millennials would be paying for this given the current climate. No one should really be traveling anyway, and so the usefulness of the features are simply not there. But still, this doesn't change the free aspect of Monzo. It's good they are thinking about these additional premium-based features. It's a simple case of if you like what you see, you can pay for this fee every year. But if you don't, keep using the free version. That's definitely what I plan on doing. And so it's no surprise that some of the Apple stores throughout the world have been closed during the pandemic, and there's just been more customers that are buying online as a result. And so Apple has been using these retail stores, which have been partially shut, to ship products from one location and then store them at the retail store to guarantee faster deliveries. Now, there's been other companies that have done this in the past. It's Apple that has just started to use their retail stores as a distribution center. I think it's a really clever idea. In the past, they were simply shipped from a warehouse, which is in close proximity to a given region. And then sometimes that warehouse wasn't even possible, and so the good would come directly from the likes of China. But now those products are brought one step closer, given that there's more retail outlets out there. And so with 300 stores all prepared to be able to operate in this manner, the likes of the US and Canada, their customers will see faster delivery turnarounds. Now, on top of that, anyone who is far away from the likes of a warehouse or even a retail center, Apple has partnered with the likes of FedEx and UPS to help deliver the orders. So that is going to reduce delivery times. On some occasions, it's expected to be delivered the same day that the customer places the order. That's definitely a place that we would love to be in. And so right now, Apple has just been testing out this program, and it's with a small number of stores. This isn't operational in all the stores in US and Canada, and it hasn't come to the UK yet. And so this is completely hypothetical, but if you have a retail store and you have additional space, if there's easy access for vehicles to load the goods, then we could have benefits there where customers can still look around the store as usual, but we still continue with that increased delivery speed as well. So thanks for watching, everyone. If you enjoyed this video, do give a thumbs up. New videos are posted at 3:30 PM GMT every week. And with that said, I'll catch you in the next one.